welcome to the Mutual Fund Show. My name is Neeraj Chan. In the next 25 minutes or 20 minutes, we're going to be discussing a very important aspect. I call it very important because so many of you in person, on Twitter, etc., have written to me saying that you would want to know about some of these alternatives. Alternatives to your money lying in a bank account, whether in a savings account or a current account for that matter, or a fixed deposit. And what are the better avenues, risk-free avenues of investing that money over different time frames? So we thought it best to get in two experts who probably advise their clients day in, day out on a lot more than such options, but to tell them to tell us about what are the options available for you if you want a risk-free option. Gurmeet, Chadha, Amit, Bivalkar, they need no introduction really. They're present across media platforms, but joining us on the Mutual Fund Show here again. Gurmeet, Amit, really good of you to take the time out. Thanks for joining in.
Thank you, Neeraj.
Thank you, Neeraj.
The pleasure is ours. Okay, so that's the framework, right? People wanted to know what to do with their money if they have different time horizons. So, I mean, I can't figure out what time horizons they have. So let's try to divide it into three time horizons. One is less than 1 year. What should people do with that kind of money? One is between 1 year and 3 years, arbitrarily chosen by me. And then one is over 3 years, wherein probably the tax benefits of that funds coming, right? So, Gurmeet, can I start with you? For people who are wanting to invest their money for less than 1 year, and the money is lying in a fixed deposit or a savings bank account, what are the options and why? Mutual fund route.
Neeraj, excellent choice, because I think people just color debt investing as just one umbrella, and they don't do sub-asset allocation, which my view is very important. I can add few basis points which can make a material difference. And not all debt investments are risk-free. We've seen various episodes, right? Not only the credit ones, but sharp movement in interest rates in 2013. We are seeing some of it, right? Last month, some yields hardening. So less than 1 year, we divided Neeraj into basically two buckets. One we called this as an on-demand bucket, which I may need money in next 2 months, 3 months, 4 months, in that kind of an horizon. You can look at liquid and ultra short-term funds in that space. One very important point in debt investing, which is a starting point, is that your horizon has to be in sync with the duration of the fund. So a 3-month bucket can't have a 3-year maturity of the debt portfolio. It's very, very important, and I'll cover more of it as we progress in the show. So one is on-demand bucket, which you may need money at a short notice, and there you don't want any MTM movement. So liquid and ultra short-term funds make sense. They typically give returns close to the repo rate. Plus minus 50 basis points, so you can make 4 or 5 basis points. Mind you, a 3-month FD would be far lesser. A 6-month FD would be far lesser. Then the second category is where you can spend up to a year, right? About, let's say, 6 to 12 months in that. Then you can look at arbitrage funds, which my view is something which is again very abused term, the word arbitrage. The funds are nothing but they take advantage of the price difference between two markets. It could be two exchanges. It could be cash and futures. Right? So if Nifty is, let's say, 1,000 on spot and 1,100 on future, I can buy spot and simultaneously sell future, because on expiry, the price will merge. And it basically takes advantage of it. The equity portion is 100% hedged. So because there are a lot of funds in this category, people tend to get confused. And some part of the money goes into debt. Sort of one. The advantage of arbitrage fund, Neeraj, is the tax advantage. So this is treated like equity. So your short-term capital gain is around 15%. So while the pre-tax returns would be broadly similar in that 4 to 6% bucket, historically I'm saying, the post-tax returns are a touch better, because in debt funds, the post-tax returns will get added straight to your income. So people with higher income slab can also look at arbitrage funds. So this is the 1 year category for me, on-demand bucket, and something which can be done for, let's say, 6 to 12 months.
Okay. Amit, what about you? How would you characterize the less than 1 year time horizon for people who have money in fixed deposits and are wanting slightly better returns? Safe but better.
So when you talk of safety, then clearly return is not something what you should look at. That is rule number one. But if you're looking at safety, clearly you have got some banks who are trying to attract deposits at 6%, 7% also, that we all know. So you have got some private banks which are taking money at 5.5% to 7% from clients. I think that's a pretty decent alternative. No need to move money from there. But what I feel, and as a company, what Sapient actually is advising clients is, we believe that there is a fight between the market participants and RBI on when the rate reversal will happen on debt. So 1 year money, if you divide between below 6 months and above 6 months, we are advising to put money into roll down funds which are having maturity at March 22. And you will have those funds which will not have rather I should say, a least impact if there was a rate reversal in the market. So namely like funds like say a DSP savings fund, which is a March 22 maturity, or a Invesco money market fund, which has a March 22 maturity, or you look at even a corporate bond fund of DSP, it's a March 22 maturity. So you have got Axis Banking PSU, Neeraj, who also is June 22 maturity. So money which is there for say 6 months, we are advising people to put in roll down which are maturing in March of 22, so that you will have minimum reset. This time in debt is actually what one should look for, is protecting your capital, because as Gurmeet said, your interest rate risk because of the duration is going to be very, very high had the rates to be reversed. So when you're putting money in debt, what RBI is actually doing is, because it's a lower for longer kind of interest rate scenario, every investor is actually pushing himself one level of risk higher than what he's sitting at. So ultra short term guy is moving to maybe a low duration is moving to a short term is moving to a medium term, and medium term to a bond fund. I think one should not get enamored by the yield to maturities on these funds right now, but we should actually look at what is the maturity profile of your investment and what is the maturity profile of the fund. We have been all taught, Neeraj, through 2015 till 2020, that it is YTM minus expense that you will get on a debt mutual fund. I think now it is going to be YTM minus expense minus capital loss if you are going to mismatch your maturity. So what is more critical is, if you have that kind of money, we are suggesting March 22 roll downs with these 3-4 funds what I told you. And rightly put by Gurmeet, I think above 6 months money, you can definitely look at arbitrage funds, because they offer a 15% tax compared to a marginal tax rate on a below 3-year debt fund. So arbitrage definitely makes way for these. But most important point is, you have to get immunized from the reversal in interest rates. And because of that, I think staying short till about 9 months to 12 months of maturity funds, this is what we have been advising. One important thing, Neeraj, is that whether interest rate reversal will happen quickly. May was a lockdown in India. If you try to look at the inflation number which has come out, the May number, it actually captures only 67% of the total inflation number, essentials. And the June number also which came out, it came because of 80% of the total commodities, goods and services which are calculated for inflation. So we have not yet looked at the entire inflation number. And if this surprises you on the upside, then you will see some interest rate movement happening. And therefore, one needs to be cautious when it comes to below 1 year investments.
No, and that's a pertinent point as well. So thanks for that, Amit. Gurmeet, Amit, give us some names. Would love names from you, but also, if you can, but also just a quick thing. You mentioned that you will tell us why should people match the investment period to the maturities, right? Quick class there, and then some names, if you will, on both the categories.
Yeah. So Neeraj, as I said, debt funds carry 3 kind of risk, right? One is credit risk. Second is your duration or interest rate risk, and third could be your liquidity risk, which could later lead to credit. So I'll cover the interest rate risk. So let's say there is a bond trading at 100 rupees and offers you 5%, let's say, coupon 1 year. If interest rates tomorrow go up by 1%, as Amit was pointing out, the new bonds in the market will come at 6%, right? So nobody will touch your bond at 5%, which means the bond at 100 will have to start trading at 99 to make up for that 1%, right? I'm giving a very...
No, please do it that way. It's much better that way, yes.
So your bond would start trading at a discount, which will reflect in your NAV. So if you have a 1 year horizon and your maturity is also 1 year, over a period of time that discount will, you will eventually mature and get face value. So you will, but if your maturity is 3 years, then the impact would be 3%, right? And so you came with a 6-month horizon in a 3-year maturity fund, you might just end up losing 3%, which is almost all your return you would have probably made in 6 months. So in a rising interest rate environment, in fact in any environment for that matter, your horizon and the duration of the portfolio should be in sync. I'm not saying it.
How do people figure that out, Gurmeet? How do people figure out the duration if they don't have an advisor like you or Amit?
So it's available, Neeraj, on public domain on various websites.
Okay.
Something it's called modified duration. Modified duration is a measure of interest rate sensitivity of the portfolio. So if modified duration is 1, which means if yield goes up by 1%, my portfolio will also move 1%. Both ways. There's an inverse correlation. Take a note that. Also look at the portfolio very closely. Right? Just look at the, we generally don't look at the portfolio. Look at the credit quality very closely. You should not have names which you are not very, comfortable at. If you have more AA names, right? So just be a little more careful. We are in an environment where it's important to go level 2. You spoke about few names. So in arbitrage, the top quartile funds are Kotak, Tata, Nippon. I think they've done very well. Although the difference, must tell you, Neeraj, is not much. But every basis point counts, right? In the end, in ultra short term, there is ICICI ultra short term. Amit made a point about the Birla Savings Fund, so that category can be looked at. And I agree with him. Some roll down maturity. Again, his point was that the maturity is March and June, so it should coincide with the. Just to give you one more clarity, roll down maturity means the maturity will keep reducing. So there are two maturity. One is constant maturity. Constant maturity means the portfolio will always have that kind of maturity.
So Neeraj, one more point here is that what is going to happen is that for a brave-hearted person, even the next 1 year, your credit funds are going to deliver good returns.
Sure.
Because last entire 1.5 years, there is no credit pickup in the market. So you don't have any credit which is given by the banks or mutual funds, any which case. And second thing is the cost of money is so cheap. That many of the credit guys have actually borrowed at low cost and prepaid their high cost debt. So even a category like credit will do well, but don't mistake it that this is going to be forever. So the cost of money and the availability of money, since both are right now in abundance and cheap, you will still see some of the funds delivering better returns. But please watch your step. It's like they say in a swimming pool, Neeraj, you have a diving area, a children area, a relaxation area. But the average depth of the pool is 5 feet. But the children area is 2 feet and the diving area is 12 feet. Don't go by the average and don't go by the average return of the fund. It is more important to match your profile with that of the fund.
Yeah. And viewers, by the way, frankly, if you want to take a little bit of risk in such scenarios, it's best to do it with the help of an advisor. Out here, the purpose of today's show is to try and give you a complete replica, so to say, for an almost risk-free kind of an option on the mutual fund side, which will be better. Now, just before we move on to the next category, very quickly, 30-second answer each. Gurmeet, for the options that you gave, what is the typical, I'm not saying an exceptional savings or an FD rate, but a typical FD rate and the differential that the options that we've spoken about will give to the investor?
So, Neeraj, yeah, in arbitrage fund, if you see typically when the bullish sentiment is there and volatility is high and interest rates are, let's say, inching up, typically the carry goes up. So there is a pause. So right now the carry is about 40-50 basis points a month, which is typically in that 5% kind of a pre-tax bracket. One good thing is there is some degree of forecasting. I would not say you can forecast arbitrage returns, but rollover spreads to a large extent, you can figure out a range. Which could be plus minus 100 basis points. So 5-ish is what right now the spreads are. Let's say for July, the spreads is around 46, 48 basis points. So taking 5.5 as a pre-tax yield, assuming somebody withdraws before 12 months at 15%, you will probably make about 4.5. Now, if you compare that with a fixed deposit at 4%, let's say for SBI, 3.5%, 4% post-tax, and if you're in the highest slab, 3%. So the return differential could be around 100 basis points.
Would be lovely. Amit, quick question to you. Similarly, for the roll down maturity option that you spoke about, just a quick idea about the differentials.
So I think you will end up with a YTM of about 4.5% to 4.25, when it will come to roll down maturities. That is what we will look at March and June of 22.
Okay, great. Thank you, gentlemen. So this is the first option. Viewers, I hope you got a sense of this. If not, you can, of course, see this whole thing again and get a sense about the less than 1 year option. Now, for 1 to 3 years, Amit, I know your answer, but I'm still asking you, right? For people who want to have this amount in a, and they have a need 2 years out, right? And they have the money and they have the choice of either putting it in a fixed deposit for 2 years or what have you, versus looking for a better option. On the mutual fund side, what is a better option? Risk-free.
So on the mutual fund side, clearly I would say don't go for the bond ETF categories, which people are selling for 2-3 years from now. I think one should avoid that because the differential between what you can say cash deployment and incremental investment, Neeraj, is actually very, very little. So I would still wait for the next March or April to get a good yield on my portfolio and then redeploy that money rather than hurrying it right now and putting money. One thing, apart from mutual funds, what you can look at clearly is you have got 2023-24 perpetual bonds of banks like SBI and Bank of Baroda, which are still giving you 6.5%. So if you have the wherewithal to buy these bonds, because there is a call option on these in November 23 and 24. So if you have that 2 year, 2.5 year kind of money, these bonds actually will be a better option than going in for a FD as well, Neeraj.
Okay. Well, viewers, so this is, yes, it's a mutual fund show. Sometimes our guests give some other nuggets as well. So welcome, Gurmeet, same to you. I know I told you that let's stick to mutual funds. If you have some options, no problem. But between 1 to 3 years for somebody who's looking for an alternative for fixed deposit savings account, safe, reliable, but better returns.
So Neeraj, keep it simple. Look for good short-term funds. As the name suggests, the short-term funds carry 1 to 2 year kind of maturity profile, and so something like, let's say, an Axis short-term or a Birla short-term. There are some short-term funds which can take some bit of credit call, but those calls are like on some AA plus papers like Tata Power or some of the pubs which Amit was pointing out to, just to give you a bit of a kicker on the yield. Good short-term funds, again, matching your, repeating that point, matching your horizon, the duration. So we know, since I spoke about Axis short-term, the modified duration is around 1.7 years. So typically an 18 to 24 month money can be par. The YTMs, Neeraj, right now are around 5-ish, 5/4. So the yields, unfortunately, are not. They have come down. They used to be pretty high. So, and don't get carried away by last 1-2 year returns, because we've had the best bulls bond market rally behind us. So you typically tend to get carried away seeing 3 year returns being 9-10%, and hoping that I will repeat that kind of performance. But 5-6% bracket, good shorter funds. Also some of the corporate bond funds which run a 2 year kind of a mod duration, like ICICI corporate bond fund, IDFC corporate bond fund. Some corporate bond funds, these have also taken some cash fall. They are right now in a situation where they think that the yield curve will evolve more as RBI is reluctant to add. So IDFC, some of them have also added some cash to take advantage of it. So as I said, please look at the portfolio once. I might sound very technical. It isn't very technical. You just have to go level 2 in terms of understanding where you are investing and what the portfolio is holding. I think if you can do those 2 simple things, I think that investing isn't that difficult.
No, well, yes, it does sound a bit Greek and Latin at times to people, but yeah, if you can just kind of take a little bit of effort, viewers, you might be able to decipher what you're getting into, and that's a great thing. Even if you have an advisor, it's great to know, and then debate with the advisor as well once as to why and how before you put your money to work. It's great to know that. Okay, so that's the second option, and 2 separate kind of options out here, viewers, so you can pick and choose. Now, for a vast majority of people who park their money with a horizon of 5 years, you might do a recurring deposit in a bank, you might do a fixed deposit for 5 years. The bank might give you whatever. Actually, a lot of times banks give you a slightly lower rate of return as well at times for that longer duration. And so many of you wrote that, what do you do if you want a slightly better return? Kyunki paisa to pada hai bank mein, kahan dalna? So Gurmeet, this I'll start with you again. Yeah. For people who want to park their money in a time horizon longer than 3 years, what are the options?
Yeah. So Neeraj, I think this is where you actually score the most differential over traditional deposit is because you get indexation benefit. Right. So let's say if inflation is 5%, let's say for right now the CPI print is 6, let's say 5%, and you put 100 rupees today, and if you add 5% on inflation every year, 3 years, your cost of purchase becomes 115. Right. So and let's say if you're even getting 6%, 100 becomes 120. You only pay tax on $5 because your cost of purchase is 115. So there are a few options, Neeraj. So I'll just spend some time on the yield curve. I know it sounds a little fascinating. So we've added a very steep yield curve, Neeraj, because your repo rate was 4 and your 10-year was 610, 620. So there was a 200 basis points, difference between your overnight rates and the longer end rates. Right now, the juiciest part is that 4-5 year. That's where you are getting the yields slightly higher. So if you buy a state government bond today, 5-year bonds, if you see, you will get them at 620, 610, 630. Right. So that's where. So if you can take a 4-5 year horizon and you can make a portfolio which largely is into government bonds, state development bonds, and some of the AAA issuers, you can look at something like a government bond fund of Aditya Birla, again rolled down. Bharat bond 2025 maturity, again has about 5.8, 5.9 kind of a YTM, almost negligible expense. A good fund. There are a couple of fund houses which have come up with PSU and government bond index, which is a little passive strategy. Again, YTM's inching to 6. So if you go for about 3 years plus, and if you can make it 3.5 years now, you are already in July, August, you actually get 4 indexation, which means your pre-tax returns and post-tax returns, the return differential could be very less. So I'm not projecting return. Let's say you make 6%, right? Your post-tax return could be, let's say, at 4 indexation could be 570, 580. Now that's a 200 basis points differential, Neeraj, on every year, right? Over a 3-year basis. Another option, if you are, and I'm taking this liberty, if you are not in the highest tax bracket, RBI has this floating rate bonds, 2020. They give you 725. So this is linked to NSC plus a spread of 65 basis points. Correct me if I'm wrong, Amit, if that's a spread. And the floating rate fund will ensure that if the yields go up, right, because it is a floating rate instrument, your yield will also be taken care of. So if you are if you're not at the highest tax, which is 30%, if you are, let's say, at around 20% or 10%, even RBI floating rate saving bond, Neeraj, makes sense. It has a 7-year lock-in though, I must add to this.
Okay. So Amit, you want to come in, and I just want some clarity about this as well. Yeah, please first.
Yeah. So Neeraj, I think what I will suggest on a more than 3 year towards 5 year is a combination of 18% short-term fund and a 20% mid-cap ETF.
This is a bit complicated for people to understand. Amit, simplify. Yeah. Take your time.
So out of 100 rupees, what you have to invest, if you have a 5-year horizon, if you put 80% of your money, that is 80 rupees in a short-term fund, and 20 rupees, you just go and buy a mid-cap exchange-traded fund, you will beat a credit risk fund on any parameters over 5 years. So if you want to really make that yield to work for you, because 5 years money, Neeraj, I don't think so you should put in debt any which case. So people who are willing to put money away for 5 years, and if you don't want to take risks on your portfolio, if you put 80 rupees in a short-term fund and 20 rupees in a mid-cap, if you find a rolling return for 5 years, you will beat even the best performing debt fund in the market on 5-year rolling returns. So
yeah, but then you're taking an equity exposure, right? Where in the 20% bucket. So if somebody has equities already.
Yeah, so that's the point that people are moving from arbitrage fund to equity savings category, which has a 16 to 40% equity exposure naked, which is not covered. That's a bigger risk than taking a 80% short-term and a 20% mid-cap ETF. I think that is what is more.
So that point is well taken. Surely, but this was not a relative option to something that people might be doing. I promised the viewers that we will stick to something which is strictly, again, the gentlemen, trust me, the place where I'm coming from is a lot of people who've written are people northwards of 65 years, 70 years of age. And their view is that they strictly don't want equity exposure. And which is why I was requesting that if we can kind of not do that thing. So Amit, my question therefore to you is, so that's a very good strategy, Amit, I'm sure of it, since you've said it. But if somebody doesn't want equity at all over 3 years, is there a good option, or would you say that no, don't put in debt?
No, I think if you are not going to look at the volatility which will come because of the interest rate rises in the next 1.5 years, I think going for a medium term fund for a 5-year term, you can just go and sit there. The problem, Neeraj, is that if interest rates go up, you will see a muted return this year, which is say 3-4%. Next year, you might see 5%. The third year, you might see 6%. So your average is going to be at 5% return on your 3-year money. And that, as Gurmeet was mentioning, if you have a 5-year bond fund which is at 570 and you don't want to look at the volatility in between, so it's just fill it, shut it, forget it, buy that 5-year bond and just sit tight, you will still make your YTM. So most of the time, if we try to look at what is happening to the NAV, I think that's where the panic sets in. But you need to go and buy and hold strategy on any of the fixed maturity plans which will come out, or probably a 4-year bond fund or a 5-year roll down strategy. I think you will make your money anywhere between 5 and 6%. So you can definitely look at such options. And end of the day, when you're putting money in debt, you are looking at protection of capital. You are not looking at maximizing returns. So to all the viewers of Bloomberg, my suggestion is, if you're looking at return of capital, then don't look at returns. If you're looking at returns, then probably you have a problem on return of capital of yours. So make that distinction very clear. In debt, look at something which is better post-tax and therefore come to debt mutual funds. If it is for higher return, clearly you need to have different strategies in debt.
Well, so viewers, as I said before the show, that if you want highly nuanced returns, then you need an advisor. But however, we try to simplify to give you some options. If you are putting purely into fixed deposits or savings account, then you're actually not growing your wealth, you're destroying it by virtue of the inflation being where it is, or where it will be maybe 2 years out. And therefore, hopefully this show helps you in trying to make some better decisions. Of course, having an advisor would be the best, but if not, hopefully this show has helped you. Yeah, Amit, very quickly, 30 seconds. We are running out of time.
Neeraj, yeah, yesterday RBI came out with a circular that retail investors can now buy government security. A lot of options for clients in 3 months. This system will be set up. You can just go and buy a 10-year government security, which will today yield you 6.1, 6.2. I think that is going to revolutionize the way retail is buying debt. I think that is going to be very interesting.
Okay, then, well, maybe viewers, a separate segment on this, maybe in the next show or the show after that as well, in order to help you understand this. But for now, Amit, Gurmeet, gentlemen, thank you so much for taking the time out and giving us a bit of a classroom into how to go about making safe investments, which are better alternatives than a fixed deposit. Thanks so much for taking the time.
Thank you.